Welcome back to the channel, investors. Today we are going over IWMY, which is a Defiance ETF. It's the Russell 2000 Enhanced Options Income ETF that currently is yielding 111%. That is the current distribution rate according to their website. So today we're going to look at this fund. You guys know how I feel about these funds that have these insane distribution rates. There's always a caveat to it, but we're going to talk about that. I'm not going to lead you guys astray. We're going to run a couple of different calculations on it. We're going to go through the dividend history. We're going to see the drip, and then we'll run those calculations to see how much money you would make if you invested 10K into this fund right now. We're going to base that on the current distribution rate and the historical distribution rate and give you two numbers, one probably more realistic than the other, but you never know. But I'm curious, what do you guys think about these funds? And if you're interested in learning more about high yielding ETFs, stocks, REITs, everything, dividends in general, don't forget to like and subscribe. It helps me out a bunch with the channel and lets me know what you guys are enjoying. But these funds, I'm curious, do you think these can compete with the YieldMax ETFs that are absolutely destroying the investing sector right now for high yield investors? They've been doing really, really well, some better than others, but I want to know, do you think these could be the YieldMax killers? So let me know what you think in the comments, what you think about this one overall. And if you want more videos on these Defiance ETFs, I'm happy to oblige. Thank you guys for watching. Let's jump right into it. We'll begin with the price appreciation. I always like checking into this. You should always look into it with all stocks, ETFs, anything that you're buying on the stock market. And we can see 1 month they're down 7%. This is consistently what happens. It drops pretty heavily when they pay their dividend and then tends to trail back up. Now, the problem I see with this is NAV erosion. You are going to continue to drop 5%, and then it only rose 4.6%. That one wasn't too bad. This one fell to 38 after the dividend was paid and then rose all the way back up to 6% above, back up to 40. So we see this since the beginning. And so since the inception of the fund in October 31 of 2023, we can see it has fallen almost 40%, which you never want. Now, I'm not ruling this one out yet because the distribution rate is so high, and it has been increasing actually, but that is because partially the price has been going down. But if they can pay consistently, even with some NAV erosion, if you can make money, this may be a good option. Let's check out how this fund is different and why I like it. This is my first time looking into these Defiance ETFs, and they are very, very interesting. I like the look of the website. They do a good job, and the distribution rate we can see right here, 111%, is insane. Pays out monthly. These are a little bit different, though, than what I've seen with some of the other funds. The main thing is down here, they use it uses daily options to realize rapid time decay by selling in the money puts. So what I've seen a lot of is covered call positions, synthetic covered call positions, but this one is using puts, which is a little bit different. And if you aren't familiar with options, that won't make a lot of sense to you. But I'm not going to go too far into it because it is really complicated to explain. Once you understand it, I promise it's like riding a bike. You'll never forget it. But we can see the fund's primary investment objective is current income. We've seen that with all of these funds. They all prioritize current income. And the fund's secondary objective is to seek exposure to the performance of the Russell 2000 index, subject to a limit on potential investment gains. We've seen this language before with the YieldMax funds. We've seen it with a couple other funds as well, the Roundhill funds. They want current income, and they're trying to get you some exposure to the performance of the underlying fund, which is good. Now, the Russell 2000 hasn't been performing great, but it also is some type of hedge compared to the other, the NASDAQ, the S&P 500, if you're wanting to own something that's different. So we just saw RDTE launch a few days ago, and that one is a weekly paying, completely different fund by Roundhill, but that is one of the first ones I've seen that is going to be writing calls on the Russell 2000 as well. So this seems to be growing in popularity, which I don't think is a bad thing by any means. We see the expense ratio of 1%, which is very, very high. I've said this over and over and over again. Most of the time you would see 0.3, maybe 0.6 on typical ETFs, but these ones, they do require a lot of work to be done for writing these calls, for writing all the options. And so you're going to get some money from the premiums, but they want some of that money in the expense ratio because it is a ton of work. So I'm not surprised by that. The net assets, 127.46 million, decent. Nothing crazy. That could continue to grow if this grows in popularity, but you can't tell. No one knows what this fund is really going to do. Then you can go down, you can see the performance year to date, 7%. That's on the NAV, and the market price is 2.5%. You can go through the top holdings, distribution history. We're going to check that out on Seeking Alpha. It's a little bit easier to see, but all in all, the website is not bad. There's a ton of these ETFs as well. You can see they have at least 4 or 5 others. I will be doing videos on those if people are interested. They have income ETFs, they have leveraged ETFs, and thematic ETFs, which I'm guessing is something like tech and stuff like that. So definitely a beautiful website. Let's go ahead and jump into the distribution history and see what this thing has been paying out. On Seeking Alpha, we can see the dividend history is as expected. It's all over the place. If you're new to these types of ETFs, because they are writing options, they're writing calls and puts, the volatility in the market will affect the premiums that you're getting. So you're not going to get consistent income. And so that is one of these downsides to the covered call ETFs, to the put ETFs, to all the ETFs that have to write using these option strategies, and some of them can do it a little bit more consistently than others. The YieldMax ones are all over the place. You never know what you're going to get, and it also has a factor depending on what the underlying stock is doing, what the underlying security. So if the Russell 2000 goes up, you'll likely get a better dividend, and so on top of the price appreciation as well. So looking at this, when you look at the dividend, the chart of the price to the dividend history, we can see every time it pays, it drops. They have paid a total of 10 dividends so far. Let's look at we'll look at the scorecard and we'll see exactly what Seeking Alpha thinks. So they have a forward yield of 87.62%. This is a little bit off because of the fact it's only paid 10 dividends. It hasn't paid for the full year. So far, it has paid out 32.50, which is insane, 32.50. And it's a $37 stock. So with these last 2 months, you would be getting a 100% distribution rate, probably maybe even more than that. Back to the dividend history, their last one was $3.67. The all-time high was $4.23 and the low of $2.09. So not terrible. We've seen, the other ones range from 5 cents to $5. This is a little bit better than that. But growth, they don't have a lot of history on their growth, and growth is not going to be a factor with the dividends on these ones just because of how these ETFs work. So it is really interesting, the information we got from the dividend. There's not a whole lot because it hasn't been trading for a full year, and even then, with the price reduction, I'm curious to see if people are making a lot of money on this. That being said, let's run this through a drip calculator. That'll tell us the actual return for the year and the expected return for the last 2 months. I always have my go-to dividendchannel.com for their drip calculator. We have IWMY, our underlying fund, and I'm comparing it to RUT, which is the Russell 2000 index. So when we chart this, we can see that the Russell 2000 outperforms. I have seen a lot of people saying, the underlying fund will always outperform the ETF, but that's not necessarily true. Some of the other ones haven't been outperformed by the underlying ETF. But I do see that being a pretty common factor. So most of them, I would say that's a pretty safe bet. That being said, your total return with the Russell 2000 is 34.63% since the inception of IWMY. Whereas IWMY has returned at least 18%. So there is a bit of a disparity there. You would have been better with the Russell 2000, but you wouldn't have that immediate income, which is why people own these ETFs. That being said, they're having an annualized gain of about 20%. So when I run the calculations, I'm going to do both. I'm going to run it based off their last distribution, if they can continue that rate, and I'm going to run it based off of the annualized gain of 20%. So we'll start with the crazy 20% one, and then we're actually going to go to our full 100 and whatever percent distribution rate and see just how insane those numbers end up being. Using Market Beats Dividend Calculator, you can put a ton of information in. So remember, we're starting with the current return. So just under 20% return, which is still phenomenal. It's not anywhere near 100%, but this is still a very, very solid return. In fact, if you asked, I'd say 95% of investors would be super happy with this kind of return. So when we throw this in, it adds to $10,000 equates to 268.889 shares. And we have it as an individual stock, monthly payments with drip on. And so in 1 year, your ending balance is $10,187, almost $88, which is a total return of 21.88%. Now, I'm going to do a disclaimer here, so no one jumps in the comments and says this isn't accurate. I know it's not accurate, but we also don't know that this stock won't perform this well. We have no idea. So when people come in and say, it's not realistic, it's really not. And so this is part of this is just to see what would happen if the fund could perform this well and could continue to perform this well in this instance with the 20% return. I'm not saying that it's going to, and we have a lot of factors that I've removed because I can't predict them. I don't have any taxes on here. I don't have any price decrease, which we have seen with this fund, and I don't have any dividend increase, which we've also seen with this fund. So I'm trying to balance it out, and so I hope that that makes sense. But I'm not trying to predict what this fund will do whatsoever. I'm very curious, but I don't know. And I think if you listen to someone and they say they know, you probably shouldn't be listening to them. So after 1 year, we get a pretty good return of 21%. When we jump to 5 years, I do have drip on, which is important. At 5 years, your 10K invested would end up being just under $27,000, and your annual dividend income is just under $6,000, which is phenomenal. You're yielding 60% on your initial investment every year now with drip. And so that is the power of drip. That is the power of compounding. When we jump it up to 10 years, it just gets better and better. We can see $72,000 after 10 years of your starting balance of $10,000, which is a 600% return, your average return of $21.88, and your annual dividend income of just under $16,000. Making $16,000 a year at that point would be phenomenal. We're going to go all the way up to 20, and this is where you see the returns really start to take over. Oh, man. I'm getting ads. Your ending balance of 20 years, according to this, is $523,000. Now, this is without another annual contribution. You can see I have no money added besides our initial $10,000. So this annual contribution being zero shows your 10K has gotten you to $500,000. And 20 years is a long time, but that is still a phenomenal return. Your annual dividend income is $114,000. You'd be what? In the top 80% of Americans with this income alone, which is insane. If you did this in a Roth account or a retirement account, it would be absolutely phenomenal. Let's go all the way. We'll go to 30. So let's say we'll put a little scenario on this. Let's say you're 25 and you want to retire at 55 and you have all your money in a Roth IRA. So you're not getting taxed on it. It's post-tax money. You were already taxed on it. At this point, with 10K invested into IWMY and a very conservative, I would say, 20% return, you are getting $3.78 million every single year. Your total return is just under 40,000% with that average annual return of just over 21%. And your annual dividend income is $827,000. You're getting that every single year. What is that every month? I want to throw this in and see what it is every single month you're getting paid. So if we do, let's do 827,775 divided by 12. You're getting almost 69,000. The numbers always end up being 69, and I don't know how that happens, but you're getting just under $70,000 a month. You're getting more than what most people make in a year in a month. So it definitely is a phenomenal return, regardless of the actual numbers that we run. And that's just, again, based off the last 10 months of returns. Now let's throw in the insane distribution rate that they have from their last payment and see what that number ends up being. Just off of this 110.96% distribution rate, it's already insane. We can see our ending balance, again, this is 10K invested. 10K invested at the current share price. Our ending balance after 1 year is almost $29,000, and your total return is 189%. Now, I know you're probably wondering, well, why is it so high? Why has the total return gone up so significantly? Well, with drip on and monthly dividend payments, when you're yielding this high of a number, it's going to really compound extremely quickly, and people don't realize that, and that's why it's fun to run the numbers on these. Again, same disclaimer as before. I'm not predicting this. I'm not saying it's going to do this. What I'm saying is if it continued to trade this way with the same dividend yield, with the same distribution rate, and you didn't have price increase or decrease or an increase or decrease in the dividend rate, this is what it would do. So after 1 year of holding this, you would have $54,000 in annual dividend income just based off your initial $10,000 investment, which is now up to almost $29,000. And these numbers are going to get more and more insane. This is why people don't like doing these calculations on these funds, because it's not going to return this high. I can almost say that with full confidence. But after just 5 years, your ending balance is already $2 million and your annual dividend income is $3.8 million. And people come at me and they say, oh, well, why are you running these calculations? Because it's totally a waste of time. It's not going to do this. And it's not. There's a very, very small chance that it could. But it is fun to run these numbers and see for ourselves how this return could just completely destroy all the other stocks that we've been tracking. And so let's kick this up. We're going to go to 10 years, and it's going to get into the crazy numbers that I don't even know the names of. Now we're at $406 million. Your annual dividend income is $768 million, which is absolutely insane. I'm going to go to 20, but it's just going to get crazier and crazier. So we have surpassed a million billion. We're in the trillions now. You now make $16 trillion. You have $16 trillion after 20 years, and your annual dividend income is 31 trillion. Is that trillion? Yeah, because there's millions, billions, trillions. And so same scenario. Let's say you are 25 and you want to retire at 55 and you only have 10K to invest, but this fund trades sideways. The price doesn't go up or down. The yield stays the same. Oh my gosh. You can see it really takes off after the trillions, which they say the first trillion is the hardest to make. And I agree with that. Is this quintillion? Okay. Million. No. I think we're actually even missing some. So I'm not even going to try. You can see the annual dividend income is insane. But these numbers, they are fun to track. So to close out the video, I don't know what this fund's going to do. I don't own it. I'll be honest, I don't own it. But I'm curious to see how it performs against the YieldMax funds. And I'll probably do some comparison videos to see how the selling puts compares to the selling synthetic covered calls. And just track the overall fund. If it's good, then I'll buy it. And I'll let you guys know if I buy it because I'm pretty transparent with my trades. But I hope you guys enjoyed this video. If you did, if you found anything useful, don't forget to like and subscribe. Helps me out a ton. I really appreciate it. And I hope I will see you in the next video.